All right, let's talk about a company that's almost definitely in your kitchen cabinet right now. General Mills. Cheerios, Betty Crocker, the whole crew. But we're not just here for a snack. From an investor's point of view, this old school giant is at a really fascinating crossroads, and we are going to break down exactly what that means. First off, you got to understand just how huge General Mills is. We're talking about a company with that's right, 9 different brands that each, on their own, rake in over $1 billion a year. Think about that. We're talking Cheerios, Pillsbury, Nature Valley, and their pet food brand Blue Buffalo. These guys are absolute titans of the grocery aisle. But here's the twist. This is the whole reason we're talking about them today. Even with all those powerhouse brands, the company's sales volumes are actually going down. For the first time in a long time, people are walking right past those familiar boxes. So the big question is, why? To get to the bottom of this, we need to zoom out a little bit. We need to look at the major economic headwinds that have been hitting not just General Mills, but pretty much the entire consumer goods industry. And it really all starts right here. For a couple of years, food prices just went through the roof. I mean, faster than we've seen in decades. And that put this incredible squeeze on everyone's wallets, forcing families to make some really tough choices every single time they walked into a grocery store. So what happens when your budget gets squeezed like that? Well, you get this thing called down trading, and it's a really simple idea. You're standing in the cereal aisle, your budget is tight, and you start asking yourself, is this box of Cheerios really worth the extra $2 over the store brand sitting right next to it? And more, people decided, nah, it's not. So this huge shift in consumer behavior, this hunt for a bargain over brand loyalty, it created a massive problem for a company like General Mills. Let's see how that actually played out on the ground. What's really amazing about this is the honesty. You just don't hear a CEO say something this blunt very often. He's basically admitting, yeah, we pushed our prices too high. They were trying to cover their own rising costs, but they went too far. And that price gap between their stuff and the store brand just got way too big for people to ignore. And you can see the damage right here on this chart. This is the cereal aisle we're talking about. This is General Mills' home turf. And in just 3 years, the store brand's market share jumped from about 5.5% all the way up to 9%. That is a huge swing, and every single bit of that came straight out of the pockets of the big guys like General Mills. So, how do you stop the bleeding? Well, you're forced to fight back on price. In the corporate world, they call it price investments. For the rest of us, that just means cutting prices and running more sales. It's something they have to do to get shoppers back, but man, it takes a direct hit on their profit margins in the short term. But here's where it gets really interesting. Management isn't just sitting back and playing defense. They're actually making a really bold offensive play to completely reshape the company for the future. And their strategy is super clear. First, they sold off their huge but kinda slow-growing yogurt business, including Yoplait. That freed up over $2 billion. Then, they took that money and went all in on the fast-growing pet food market, buying up some new premium brands. And finally, they're building on that by launching their own innovative stuff, like a new fresh pet food line. This whole thing, this massive shift, is a giant bet on one simple, powerful idea: pet humanization. You know what this is? It's the fact that more and more of us treat our pets like actual members of the family. And because of that, we're willing to spend way more money on better, healthier, higher quality food for them. This trend right here is the entire argument for why General Mills could have a very bright future. Okay, so that's the long-term plan, this big bet on pets. But if you're an investor looking at the stock today, you're probably wondering, what's in it for me right now? Well, for a lot of people, the answer comes down to one thing: that dividend paycheck. As it stands, the stock is paying a dividend yield of almost 5%. For a big, stable company like this, that is a really, really attractive number. It's a hefty cash return you get paid just to own the stock while you wait for their big strategy to play out. And for General Mills, that's a historically high yield. And listen, we're not talking about some fly-by-night dividend. The reliability here is just incredible. General Mills and its predecessors have paid a dividend without a single interruption for over 120 years. Think about that. Through world wars, the Great Depression, pandemics, that check has always shown up. That tells you a lot about the core stability of this business. Okay, so let's put all the pieces together. You've got a core business that's struggling. You've got a bold new strategy in a hot market. And you've got this amazing dividend. All of this creates the classic dilemma for anyone thinking about investing in this stock.
I mean, just look at its valuation. The stock looks cheap. Its price-to-earnings ratio is less than half of what its competitors are trading for. So the market is clearly skeptical, and that leaves you with two possibilities. Either this is a value trap, a cheap stock that's just going to stay cheap, or it's a fantastic opportunity to buy a great company on sale.
So really, it all boils down to this classic bull versus bear fight. The bulls are going to say, look, you've got iconic brands, a smart pivot into the booming pet market, and you get paid a huge, reliable dividend while you wait, all at a discount price. But the bears will fire back, hold on, the main business is weak, their profits are getting squeezed, this whole pet thing is risky, and the company already has a lot of debt. And in the end, it really comes down to this one question. Do you bet on a century of proven stability and just collect that nearly 5% paycheck while this old giant learns some new tricks? Or are you worried that the game has changed for good and that this company's best days are actually behind it? How you answer that is the whole story.